Darden Restaurants has been developing in the U.S. markets for several decades. Some of their most well-known brands include Olive Garden, Longhorn Steakhouse, and Yard House. As of today, they have over 1,900 restaurants in the U.S. and Canada. Now, let's move on to the financial indicators of this company. The company's revenue has a mixed trend towards growth, but net revenue is not as straightforward. The company's assets are almost equal to its debts. My final rating for this company is 2 out of 10. Yes, the company owns powerful brands that are popular in America, and it consistently invests in their development, which increases the company's revenues. The company experienced a trend of declining profits until 2014 due to rising seafood prices, which increased the costs of their Red Lobster brand. As soon as the company got rid of this asset, it returned to a growth phase. However, due to the coronavirus, the business had to take on a large amount of debt, which will remain with the company for the next few years, and today the company's assets barely exceed this debt. In my opinion, the company has almost no potential for growth. The fact is that the company's business is concentrated on several brands, each of which requires its own expenses. This is not like McDonald's or Starbucks, which operate under a single brand. When I read their financial statements, I was intrigued by the fact that the company began to develop in the franchise sector. For example, in 2017 there were 78 restaurants operating under their brand, and by 2023 there were 69 restaurants, with most of the regions of these restaurants changing. The fact is that these brands are very well known in the US, but they are not as popular in other countries because the company has not developed them there. Additionally, the company owns its own restaurants in the US, which hinders franchise development in this country. Even if the company itself has difficulties developing the brand in Canada, there is no point in buying their franchise, which limits the company. I believe the company had potential, but now, when almost 60% of its profits are paid out in dividends and its assets barely exceed its debts, I doubt the company will be able to stay in business with this approach. That's why I won't be buying shares of this company. As for the price, I believe the business is significantly overvalued. The fact is that the business took on about $6 billion in debt since the coronavirus, and although assets have also increased, it raises my suspicion. If you look at their financial statements, since 2020 their real assets, the land they own, have barely increased by $1 billion, and now they have about $360 million in cash. Adding the fact that about 100 restaurants were opened during this period, this seems accurate. But where are the other $8 billion? The last time they sold Red Lobster, they just paid out that money as dividends. I believe that the price of $18 billion is significantly overvalued. I value the company at $10 billion and believe that the shares of this company should be worth around $85 each. I will not own its shares under any circumstances. Subscribe to my channel so you don't miss future videos.